You inadvertently danced around debt to income ratio.
Mm-hmm.
When we qualify for a commercial loan, this is referred to as a global underwrite, right? The bank looks at you, the asset, they take everything into account. The kind of loans that we're talking about on Fannie Mae, right? That is so, I think credit score and debt to income ratio are what, like 95% of this equation?
Yeah.
Maybe more. And so a lot of times people worry, well, I get more properties, more debt, it hurts my ratio. Now, if you're buying good investment properties, wouldn't your debt to income ratio be getting better the more debt you get?
Better or essentially just stay the same. I mean, because we're only using 75% and you've got that delta that we just have to essentially eliminate for those conservative purposes. Someone can come in and say, I want to qualify for a primary residence. And I look at what their debt to income ratio is, adding that primary residence or that new housing expense. And let's say it's 31%. Let's say that this house, principal, interest, taxes, insurance, any debts the individual has, car payments, student loans, credit cards, personal loans for a new Mastercraft boat or maybe a Nautique, G23, it's a great boat. All of that totals 31% of this individual's gross monthly income, right? So that's what you pinpoint as their debt to income ratio. Then they can come in and say, now I want to add a fourplex. And I go ahead and add what this potential fourplex would add from a cost perspective. And then the liability perspective as far as the monthly payment, principal and interest, taxes, applicable HOA dues. Then I can plug in the applicable rents that I can use to offset that payment. And this individual's debt to income ratio could still just be right at 31%. Now, once you have built this fourplex and it is considered a retained property at that point, if you have it at that point and you don't lease it out, well, then your debt to income ratios are going to be completely out of whack because you have a non-performing asset where you've got
you don't have income for the debt.
Right. So at that point, once you have completed the fourplex and you refinance and you own it and you want to go buy an additional property after that, you're going to have to show leases to be able to offset that payment. So that's when that becomes important. But at the time of completion and turnover, it's just whatever an appraiser says fair market rents are. And that's been wonderful with us understanding that and the banks working with us in working on these pre-approvals for investors. It's helped us get more aggressive with qualifying and getting individuals to build a bigger portfolio than I think they thought was possible.
I have two questions. Number one, did I just see you try to get Mastercraft to send you a free boat?
I think so. But
no,
if they
not
do...
Teague. What are you talking about?
Maybe a little bit. I mean, X-Star, any Mastercraft dealers out there,
Great
GME,
products.
Oh, wonderful. But G23 Paragon Nautique is kind of the king of the water right now too.
Yeah.
Or G25.
Yeah,
Shared a
come
smile
hang
at
out with me.
Yep.
Okay.
So
Well,
it had to be said.
If we get a free one out of the show, then we'll post a picture on. Do we have a website, Preston? We're doing some stuff. That's essentially what Preston said.
Okay.
That's yeah. So then a more real question is, what debt to income ratio makes Fannie Mae say no mas? We're not doing this loan.
You can actually get up to 48, 49%, which is pretty ludicrous in a lot of ways. I like to cap it at 43, 44, because on the front end, when you're prepping to build a fourplex, there's a 3 to 6 month process. Then you break ground, and then there's another transaction that takes place upon completion. And so when I'm doing a risk assessment to see if somebody qualifies, it's a dynamic approach because I have to see, does this person qualify now, and is their income or expenses trending in a way that they will likely qualify again for the refinance a year after that. And so I do like to leave a little bit of wiggle room in case someone's expenses do fluctuate or change, but I'm trying to typically hit the 43% number for the type of product that I am pre-approving for.